All right, we are back with our power panel. Jim Thorne of Wellington-Altus, Earl Davis of BMO Global Asset Management. We've been talking about the Bank of Canada. It's not an island. We've been talking about the sell-off in the bond market. And while we've seen a sell-off that you say there's a risk could get worse, there is a chance of this relief rally in the bond market that could create a little bit of wiggle room, some breathing room for some assets. So now I just want to talk kind of straight positioning. You sat here last year, I thought you were crazy when you said rates could go up to 5%. That's where we were. At the beginning of the year, you said, I'm all in on NASDAQ. That was a sort of great trade as well. So now, here we are, October 2023. How are you positioned for the next year?
Yeah, right now we're basically flat credit because we do see this volatile period having, but then we're going to be going overweight credit. We see it as an opportunity to buy and buy attractive all-in yields.
So lock in these yields.
Oh, yeah, we see them as very attractive.
And would you do that in bond proxies as well? I mean, I'm looking at the banks, some of them north of 7% dividend yield, the pipelines, the utilities. If you see relief in the credit market, you have to see relief in those equities too.
Yeah, we really like banks. Overweight them. We'll continue to buy as the spreads get wider. We just think diversified business plans. Utilities, if we see this sell-off that we expect in 10 to 30-year bonds and hit the peak rates where we start going long, we think that's the time to buy utilities. What we don't like...
Do you have a magic number where you think the sell-off ends?
I have a magic time, not a magic number, because it becomes illogical at times for a brief period, you know. So I don't have a top level, but I'll give you a number. If you look, as you said, 2001, we were at 5% overnight rates. 2000, we were at 650 U.S. 10-year yields. We're at 4% today.
Okay. So that gives us a sense. And now you're in that environment, because you also agree a relief rally could be coming in the bond market for 2024. Where do you want to be positioned?
I think the Bank of Canada and the Fed realize they've over-tightened, and they're looking at the data. And if they can get it clear, we've got to get through the long-term labor negotiations. And if they can get a handle on the Fed, the Treasury and the Liberals, shall we say, stop spending, then I think there's going to be a dramatic decline in interest rates. And at that point in time, what we're having conversations at Wellington right now is, when do you buy Canada? We're not doing it right now. I was
just going to ask, when do you buy Canada?
But as opposed to phoning up and saying, do I sell Enbridge, it's what do we need to see to go back into the Canadian banks? When do we need to see to go back into the utilities? And as I was on before, I said, look, I have no edge. And the question is, for me, is this. I think the United States is going to have a soft landing. I need to see that the Bank of Canada hasn't done too much damage, right, into the market. Now, obviously there's a consensus that says it's a flesh wound, like the back knight in Monty Python. If that's the case, then you need to be aggressive. But I think what's very interesting is you're looking at the consensus view right now saying that there may not be any rate cuts next year. We sit there and say, if, as and when the Bank of Canada comes to its senses and starts cutting rates, I think Canadian banks would be the first thing to buy. And then we got to go in. Look, at Enbridge's business model, does it work? If we're going to not go back to low interest rates, zero interest rates, which is what, our thesis, right? Does Enbridge business model work when the Bank of Canada overnight rate is, let's say, 3%? Yes or no? I don't know.
Can I ask a question about this soft landing? And it's kind of, it gets a little bit deep into the weeds of the bond market, but just very simple yield curve inversion is supposed to signal that a recession is coming. But the point was made that magnitude of inversion is starting to narrow, and that's called bear steepening, which actually means that a recession could be closer. Given you think some of the signals from the bond market are on the fiscal side, like how are you reading the tea leaves about what the bond market is telling you? Or are you?
Yes, I mean, I look at the bond market all the time, right? Unbeknownst, I'm not an equity guy, right? I have a PhD, right? So sorry, right? What I would suggest to you is I think the bond market, I think it was very interesting to see what happened after the dot plot came out in September, where a week after we had PCE numbers come out. And basically what the PCE numbers in the United States say is that durable goods PCE is a negative 2%. That was the anchor that kept inflation at the lower end between 0 and 2%. Okay. So we're there. The bond market is looking at that, and I would suggest we're having a blow-off top, And I think the bond market is basically looking at the fact that we're going into a low interest rate environment.
Yeah, you know what? I think you're bang on. So the bond market bear steepening, getting less inverted, is a reflection of people thinking 2024 could be an all right year.
Okay.
We actually think the bond market goes positive from inversion, but then we think it starts to flatten, go inverted again the second half of next year in regards to 2025 in the future.